Welcome to Chapter 8. We're about 3/4 way through the semester. By now you've probably had a couple of tests, you've had a couple of your assignments. As you can see, my main objective for this course is that you become familiar with terms, you know what the bar graphs look like, you know what the supply and demand graphs look like, and you're familiar with the topics and formulas that are used. So we'll continue on with Chapter 8, but as always, if you have any questions or concerns, please feel free to contact me anytime. So, Chapter 8, the application, the cost of taxation. So what does taxation do to us on a macro level? We'll look at the micro level a little bit later on. We'll continue to discuss the welfare issue of taxation and how the effects it has on economics. We've already discussed how it affects supply and demand back in Chapter 6 and 7. Chapter 8 will focus mostly on the taxes and how taxes are used and how taxes are collected. We've already evaluated and demonstrated how the tax affects the price and the quantity sold in the market, how a free market is affected by taxes, how producers and suppliers come in and out, and purchasers and buyers come in and out. We've examined the burden that taxes can cause on the market. And also we're going to, in this chapter, look at some of the things that taxes are used to help us down the road. Remember in Chapter 7 we covered welfare economics, the study of the allocation of resources and the effects of economics on well-being. Chapter 8 combines the lessons learned in Chapter 6 and 7 and addresses effects on welfare. So the main purpose of Chapter 8 is the lessons that we've already learned about economics welfare and how tax issues will be applied to them. So we'll also discuss the factors and the determinants to the degree by which the cost of tax exceeds the revenue collected by the government. So in other words, that people stop in and out. We'll also talk about deadweight loss of taxation. Is the effect of a tax surcharge on supply and demand and their influence on production and people's purchasing behavior. Taxes that lead to decrease in the price received by the seller and increase in the price paid by the consumer will ultimately end in a decrease in tax revenue for the market shrinkage. This is called excess burden. So basically what this means, if you tax something too much, then eventually people will stop using it. The book defines the deadweight loss as the fall in total surplus that results in a market distortion, such as a tax. Remember, it doesn't always matter who is paying the tax, or both the consumer or the producer are paying the tax. Both the buyer and the seller will be affected by the tax. The supply and demand will shift in one direction or another due to taxes. That's the key to always remember. If there's a tax on a product, the price that the buyer pays will be greater than the price the seller receives. Thus, there is a tax wedge between the two prices, and the quantity sold will be smaller if there was no tax. So what I want you to do is find the graph that's in your book or on your PowerPoint that has prices on the vertical and quantity on the horizontal, and it talks about the tax wedge. I just want you to see where the tax wedge would be. If the price buyers pay the tax revenue, and the price sellers receive with the tax on it, and where is the tax wedge. So I just want you familiar with the tax wedge. How a tax affects the market participants, the people who participate, both the buyer and the seller. We can measure this effect on a tax on the consumers by the change in consumer surplus. Remember, we talked about the consumer surplus in the previous chapter. Similarly, we can also measure the effect on tax producers by looking at the change in the producer surplus. However, there's a third party that's affected by the tax, one that we're left out so far, and that's the government. The government gets the tax revenue, and if the tax revenue is used to provide the services to the public, then the benefit is to everybody across the board, and it even generates more revenue. If it's not used appropriately, we all know what happens at that time. So we'll talk more and more about how the government gets involved. The government's total revenue comes from taxes. They have no other income other than us paying. So we'll keep on talking a little bit more about the government, the welfare with and without a tax, and we'll look at a couple more graphs. I don't want you to get lost in the graphs. Just remember, I want you to know the terms. I want you to be able to look at them, be familiar with the graphs. But for the main part, the vocabulary, the terms, and the concepts. Okay, inside your book, or maybe in your PowerPoint presentation as well, find the graph that talks about the quantity demanded with and without a tax. If we look at it, it should have the quantity should be on the horizontal and price on the vertical. Our supply line sloping up and our demand sloping down. You should be able to find our equilibrium price. It should show you a price that buyers pay, the price without a tax, and the price that sellers receive. And what I want you to focus on, what I want you to see in this example, is the quantity that with the tax, how much is sold, or how much the quantity is demanded, and how much the quantity demanded without a tax, what is the quantity demanded. I want you to see the major shift by adding a tax to it, how much of a reduction and shift to the left that you'll have in the quantity demanded into the market. Okay, so now let's look at the deadweight losses and the gains from trade, or the losses from trade when taxes do not allow trading. Taxes cause deadweight losses because they prevent buyers and sellers from being able to benefit from the trade. This occurs because the quantity of the output declines. Trade that would have been beneficial to both the buyer and the seller will not take place because the tax or the embargo has been levied. The nature of the deadweight loss stems from the reduction in the quantity of output exchanged. So those that have the idea that goods that are not produced, consumed, or taxed do not benefit or generate anyone will fall under this category. So let's take a look at your graph. I believe it's in your PowerPoint. I believe it's figure number 4. The deadweight loss that you see is equal to areas C and E. This is the drop in total surplus. Remember, we talked about total surplus in chapters 6 and 7. Note that the output levels between the equilibrium quantity without the tax and the quantity with the tax will not be produced. Yet the value of these units to the consumer, represented by the demand curve, is larger than the cost of these units produced, which is represented by the supply curve. So, if we're looking at the detriments of the deadweight loss and what it causes and what happens to the shift in the curves, the price elasticity of the supply and demand will determine the size of the deadweight loss that occurs from the tax. So, given all things equal, and we're talking about a stable demand curve, the deadweight loss is larger when a supply is relatively elastic. Given another stable supply curve, the deadweight loss is larger when the demand is relatively elastic. So let's talk about the deadweight loss debate. A lot of the times, most of the first thing that's brought up is always the Social Security, the tax, and the federal income taxes that are on our labor earnings. A labor tax has also placed a wedge in the wage firm was willing to pay its employee. So the wedge causes the employer to be able to pay the employee less. The employee has less money to put in their pocket. The employee spends less money in the GDP. There's a considerable debate among economists concerning the size of the deadweight loss from the wage tax. Most people do not even realize how much in taxes they actually pay a year. We have so many city, local, state, federal, and so on taxes that a lot of times we don't actually add up and do our percentages. And we'll talk about that in the end. The size of the deadweight loss depends on the elasticity of labor, supply, and the demand. And there's a disagreement about the magnitude of the elasticity of supply. Economists who argue that the labor taxes do not greatly distort the market outcomes believe that labor supply is fairly inelastic. Economists who agree that the labor taxes lead to larger deadweight losses believe that the supply is more elastic. So when we're looking at the effects that the deadweight loss has on tax revenues, it can vary. Taxes increase, the deadweight loss from the taxes increases. In fact, as taxes increase, the deadweight loss rises more quickly to the size of the tax. The deadweight loss is the area of the triangle on figure 4. If we double the size of the tax, the base and the height of the triangle both double so that the area of the triangle begins to expand. This is what is called the deadweight loss. So it rises by a factor of 4. You will not be tested on the graphs. You will not be asked to draw on a graph or figure it out. I just want you to be familiar with it and the formula that goes alongside of it. So if you do have a question about it, You'll just be able to look at that graph and be able to figure it out. Okay, so as we know, what we've been talking about so far, as a tax increases, the level of tax revenue generated will eventually fall. So the more that we're charged in taxes, the less that we'll buy, then therefore the less that the government will be able to collect for social welfare. So they understand that the more they tax us, the less we'll want to pay into taxes. So this goes back to a case study when you look back at the 70s and 80s, what we call the Laffer curve. It's the supply side of economics. I believe in 1974, Arthur Laffer created the Laffer curve. It was used a lot through Ronald Reagan and through the 80s and to some parts of the 90s. It is the relationship between the size of the tax and the level of the tax revenue. That's what we refer to as the Laffer curve. It focuses on the supply sides of economics. If you remember in the 1980s, the Laffer curve was used to support to believe that a drop in the tax rate could lead to the increase in tax revenue for the government. So less taxes collected would mean that, lower tax rates would mean higher taxes collected. Economists both on the left and the right continue to debate this and continue to argue it. Both have some believe that it worked in the 80s, and you hear a lot of people touting Ronald Reagan, and then you have a lot of people say that it didn't work because of what happened in the 90s. So some believe that the events in the 80s were more favorable to the supply story. Some economists believe that while an overall cut in tax revenue decreases revenue, some taxpayers may find themselves on the wrong side of the Laffer curve. So when you look at the Laffer curve, make sure you read over that and understand at least that it's the supply side of economics. And its philosophy is at zero percentage collected, zero tax revenue will be generated, and it's the perfect bell curve. At 100% taxes, no taxes will be collected. So just like we talk about an equilibrium price, the Laffer curve is talking about the equilibrium rate that you'd be charged in taxes. So what has Chapter 8 taught us? How taxes reduce consumer and producer supply, the meaning of the cause of deadweight loss from a tax, why some taxes have larger deadweight than others, how tax revenue and deadweight vary from the size of the tax. So to sum up Chapter 8, a tax on a good reduces the welfare of the buyers and the seller of that good. And the reduction in consumer and producer surplus usually exceeds the revenue raised by the government. The fall in total surplus, the sum of the consumer surplus and the producer surplus, along with the tax revenue, is called the deadweight loss of tax. Taxes have deadweight losses because they cause buyers to continue to consume less and sellers to produce less. And these changes in behavior shrink the size of the market below the maximum levels that surplus. Because elasticities of supply and demand measure how much the market participates and it responds to market's conditions, larger elasticities imply larger deadweight losses. So as a tax grows larger, it distorts incentives more, and the deadweight loss grows larger. Because the tax revenue is the size of the market, and however the tax revenue does not continually increase, it always is the first to rise to the size of the tax. But if the tax gets large enough, the tax revenue starts to fall, just like we talked about in the Laffer curve. And the last thing that I wanted to challenge you with for this chapter is to think about the taxes that you pay in and what percentage of tax do you pay as a consumer, seller, and or buyer in the economy. Most people do not realize that for the most part, a person working 40 hours a week, making more than $10 an hour, pays somewhere around the range of 30% of their gross income goes in taxes. So for every $10 that you make, you only bring home $7. $3 goes to local, city, state, and federal government in taxes. But think about the roads, think about public safety, think about all the things that we do get from government. So we do have to find a happy balance, and the taxation does play a crucial part in social welfare